What if this didn't have to be a reality? What if you could wake up whenever you wanted and have unlimited time to spend with your family, travel, or work on your hobbies? Most of us were taught that the only way to make an income is to work for money. But there's actually another way. You can either work for money or you can make money work for you. And I'm gonna share with you 5 ways to do that and create passive income. It doesn't take a lot of money and doesn't take any special skills. Anyone can do this. So let's jump into it. Let's first talk about dividend stocks. First of all, what is a stock? It's not some sort of conceptual weird thing that squiggles around on a price chart. It's actually a piece of an actual company. So when you buy a stock, you are buying ownership in a real life operating company that has factories, stores, customers, and sales. And by owning a piece of that company, you are entitled to a share of that company's profits. So at its core, when you buy a stock, you're buying a piece of a company. Don't forget that. I think that really makes it very tangible. Now, among all the companies that you can invest in and become stockholders in, there are companies that make so much profit that after paying all their expenses and investing back into the company for future growth, they have plenty of money left over to distribute to its owners, you, the stockholder. And this is what's called a dividend. Companies will normally pay dividends on a quarterly basis. That means 4 times a year, every 3 months, you are gonna get a cash deposit in the account where you hold that dividend stock for doing nothing other than just owning that stock. Stocks that pay good dividends are companies that are stable, have had a history of profitability. So we're not talking startups. We're not talking new companies that are just starting up. We're talking companies like Coca-Cola, Procter & Gamble, and AT&T. Now, in terms of how to pick good dividend stocks, essentially you're becoming an owner of a company and your ability to receive dividends depends on whether that company is profitable and has money to pay out dividends. So really what it comes down to is you want to pick companies that have a history of being profitable. This really means just companies that are established and have been around a long time. You also want to look for consistent dividend history. So if this company always pays a consistent dividend every single quarter with no real history of cutting the dividend or reducing the dividend, they always keep it somewhat stable or increase, that's a really good sign. Something else is you want to look for the dividend yield. Now, dividend yield is a percentage that shows how much dividend money you get given every dollar you invest in the stock. And the formula to calculate dividend yield is last year's total dividend payout divided by the current stock price. Now, the higher the dividend yield percentage, the more bang for the buck you're getting. So as an example, Johnson & Johnson is paying a dividend yield of 3.02% and AT&T 5.73%. And just to do the math together, the way we got the dividend yield is if AT&T paid quarterly dividends of 28 cents times 4, that's $1.12 for the year, divided by the current stock price of 19.37, that gives you that dividend yield of 5.7%. So that's how you do the math. And obviously you want the dividend yield to be as high as possible because it means you're getting more bang for the buck. One thing you want to look out for is dividend stocks that have a really high dividend yield that looks too good to be true. Usually if it's too good to be true, it is too good to be true. And it probably means that the company is having some financial issues. The stock price is really, really low compared to the dividend because the stock recently had a nosedive based on bad financial news or some prospects that make the company's future look very negative. So you want to be careful for dividend yields that are too high. You want to look for dividend yields that are in line with similar companies in that industry. So for example, back in the day, GameStop used to pay a really good dividend in its heyday, but once online retail started cutting into the whole brick and mortar business model, GameStop profits really started going down, yet its dividend yield looked really high. But if you dug in a little deeper to the company's financials, you would have seen that the company had a lot of debt and that your principal was actually at risk. So anything in finance and investing, if it looks too good to be true, then it probably is. In terms of how to get started with $1,000, super easy. All you need is enough money to buy 1 share. So right now, AT&T is trading at $19.37, which means you can buy 50 shares of AT&T at around $20 a share with $1,000. Nowadays, you don't even need to have enough money to buy 1 share because platforms like Fidelity offer fractional share trading. So with whatever money you have right now, you can get started investing in dividend stocks. Number 2, dividend index funds. I think this is a better way to get dividends than investing in individual dividend stocks because it gives you the benefit of something called diversification. Diversification is when you spread your eggs out in different baskets so that your financial prospects aren't so dependent on the future of one company. And diversification is nice because you don't have to worry so much about whether the GameStop that you've invested in or Coca-Cola, if that company is doing well, if the CEO is corrupt. You don't have to worry about all these little things. You can just invest in a diversified fund of hundreds, if not thousands of different companies and just get dividends from all those companies. It's kind of like instead of buying one flower, you're buying the entire bouquet and it all comes in one nice, easy purchase. Diversification lowers your risk and makes it less important for you as a beginner investor to know all the ins and outs of everything going on with each company. In terms of how to pick the best dividend index funds and ETFs, the most important thing to look for, number one, is expense ratio. When investing in funds, because it's so convenient to get access to a whole basket of stocks all in one easy purchase, you're going to get charged what's called a management fee, also known as an expense ratio. These expense ratios can range anywhere from 0.01% to 2%. So you always want to look for a fund that has a low expense ratio because over time, these expense ratios really add up and skim off a portion of your investment and can add up to hundreds of thousands of dollars over time. So you always want to look for a dividend fund that has less than a 0.2% expense ratio. The other thing you want to look for is a fund that has a reasonably high dividend yield, because if the goal here is passive income, you do want to get a yield for your investment. So just like with individual dividend stocks, you want to look for something that has as high of a percentage as possible, while at the same time looking out for dividend ETFs and funds that have yields that are too good to be true. Because once again, if it looks too good to be true, it probably is. So for example, there's a really popular dividend ETF called JEPQ, which is paying a dividend yield of 9.74% as of the recording of this video. Compare this to another very popular one called the Vanguard High Dividend Yield ETF, VYM, which has a dividend yield of 2.89% currently. Now, one ETF is providing a way higher dividend yield than the other, and there's gotta be a reason for that, because there is no such thing as a free lunch. So if we actually dig a little deeper, you'll see that JEPQ, which is the JP Morgan NASDAQ Equity Premium Income ETF, if you dig into the fact sheet and the prospectus, you'll see that the reason this fund is able to generate such high dividends is because they use options and fancy structured products and derivatives, which actually is a great way to generate extra income, but of course it always comes with extra risks. So if you read into the fine print at the bottom, these are the exact words. Should the prices of the underlying instruments move in an unexpected manner, the fund may realize losses, which could be significant and could include the fund's entire principal investment. You won't see that kind of language in a fund like VYM because VYM doesn't use options and derivatives, but JEPQ does. So if a dividend yield looks really, really high, just know that there are additional risks. Of course, that doesn't mean it's a bad idea. You just have to know that your principal is at risk if some sort of crazy big financial event happens. I know chances of that are very low, but like I said, there's no such thing as a free lunch. One good rule of thumb to check if a dividend stock or ETF that you're considering is too good to be true is really to compare it to what is the overarching interest rate in the United States at the moment. So this is something called the Fed funds rate. This is like the base interest rate of the entire country that the government sets. And all dividend yields and bond yields and every yield that you can imagine is always based off of the federal funds rate. And to find out what the federal funds rate is right now, all you have to do is Google what is the Fed funds rate right now. Okay, and at the moment, the federal funds rate is around 5.33%. So if something is paying a much higher dividend yield than that, that's when you have to dig a little bit deeper and be a little more on the lookout. Now, you can get started with $1,000, whatever you have right now. Examples of some popular dividend ETFs are VYM, which I already mentioned. There's the Vanguard Dividend Appreciation ETF, VIG, and the Schwab US Dividend Equity ETF. The ticker symbol is SCHD. Okay, and now for the third passive income investment you can make with $1,000 is bonds. So bonds are very different from stocks because when you buy a bond, you're actually lending money to a company or an entity instead of buying ownership in it. So the difference is lending versus ownership. Now, if you really think about it, lending is a very conservative way to put money to work because you're making an agreement with the borrower to lend a certain amount of money, get paid back at a certain time, and in exchange, you get payments of interest along the way. So you're guaranteed a return of your capital and you're guaranteed some fixed interest payments. It's very safe and predictable. Compared to when you buy ownership in a company, you have no idea how that company is going to do, we make our predictions, but it really depends on the performance of the company. The profits can be bigger or smaller than you expect. So compared to stocks, bonds are a lot more predictable and safe. That means the passive income yield that you can make by investing in bonds is not going to be as exciting as you get in stocks, but it's going to be a lot more predictable and safe. That being said, there are different levels of safety among bonds. Like buying ownership in Coca-Cola is probably still going to be safer, even though it's a stock, than compared to buying a bond in like no-name company that just started yesterday. So of course, it's all relative. One really standard way to quickly see how safe a bond investment is to look at its bond rating. There's two well-known rating companies called Moody's or Fitch's, and they each kind of have their own grading system for rating how safe a bond is. So you've probably seen things like AAA or CCC rated, probably seen letters and numbers that kind of look like this. So it's really like the school grading system. Getting A's means you're the best and getting a D means you're the worst. So anything in the A and B range means that it's a good, safe bond to invest in. Anything below that, you really want to watch out because you probably won't get your principal back at the end. Now, in terms of how to get started with $1,000 so that you can start receiving that passive bond interest, just like with stocks, you have a choice to invest in individual bonds or in bond funds, index funds or ETFs. And as always, I do prefer diversification. Again, it's a lot safer and easier for the beginner investor. Examples of popular bond ETFs that pay monthly interest payments, that's passive income in your account every single month, is the Vanguard Total Bond Market ETF, ticker symbol BND. And this is a fund that has all kinds of bonds in it. There's corporate bonds, so you're lending money to companies, and you're also lending money to governments. It's a nice mix of all kinds of bonds. And that's a really great place to start. Of course, none of this is a specific recommendation. I'm just giving you some ticker symbols to look up and jumpstart your research. You always have to make your own decisions. This is financial education, not financial advice. And finally, when you're selecting bond funds, something to look out for is what type of bond is it? Because you could be lending money to companies, so those are corporate bonds. You could also be lending money to governments. Those are government bonds. And obviously lending to the US government nowadays is one of the safest types of bonds you could invest in because it's the US government. You could also invest in bonds in international governments. You could lend money to the Japanese government, to the Canadian government. So there's government bonds and corporate bonds. There's a smaller, lesser known type of bond called municipal bonds, and that is lending money to local governments. We're talking to like the California government or the New York government. And these tend to have unique tax advantages because it'll give you a tax break on the state income tax. So if you invest in, for example, California municipal bonds, you won't be paying California state income tax on the interest on those bonds. So that's something to think about too. All right, moving along to the next passive income investment, REITs, real estate investment trusts. So a lot of people don't know this, but you don't need tens of thousands of dollars to invest in real estate. I know coming up with money for a down payment is a lot, but you can start investing right now in real estate with $1,000 or whatever money you have through REITs. REITs are essentially stocks in companies that own a bunch of real estate. So it's kind of the same thing. Instead of owning real estate directly yourself, you can just buy stock in a company that owns a lot of real estate. It's kind of the same thing. And the thing about REITs is they are legally required to pay 90% of their profits out to shareholders in the form of dividends. So when these companies collect all the rent payments, they're going to pass on 90% of that to you in the form of regular, consistent dividends. So I like REITs because personally, having invested in rental property directly myself, it really is kind of a hassle. It's a lot of work. And again, if you invest in a REIT, instead of investing in one property, you get exposure to lots and lots of properties, thousands. So that gives you diversification. And then of course, the REIT has professional management. They know how to manage a huge portfolio of real estate. So you get the benefit of professional management, passive income, diversification, and you don't have to do anything. You can just sit back and collect the rent payments in the form of REIT dividends. So what's not to like? In terms of how to pick the best dividend paying REITs, first it comes down to which sector of real estate. There are REITs that invest in apartment buildings, so all residential. There are REITs that invest in commercial, like shopping malls and stores. There's also REITs that invest only in data centers, which is super niche, but believe it or not, there's huge buildings out there that house a lot of computers and just cloud computing power. There's even REITs that invest only in storage. So Public Storage is a REIT that owns all the public storage buildings you've seen out there. And for dividend yield, all the same rules apply as when you're choosing dividend funds and dividend stocks. You want something to be relatively high, but if it looks a lot higher than other dividend yields, it's probably too good to be true. But just for funsies, let's just see what is the dividend yield of one ETF called the Digital Realty Trust. This is a REIT that invests in data storage and cloud computing centers. The dividend yield at the moment is 3.24%. So it's not bad. The thing about dividend yield is you're not just getting the dividend yield, you're also getting appreciation when the stock goes up. That's something that you don't want to overlook either. So one example of an ETF that pays a dividend yield that's not that impressive, but also has had really impressive growth over the last few years is VTI. Its dividend yield is 1.39%. However, if you look at the price chart, it's actually grown a lot in the last few years. So remember that if you invest in any sort of stocks, you're not just getting the dividend yield, you're also getting the capital appreciation. Okay, moving right along, the next passive income investment that you can make with $1,000 is a high yield savings account. Now, this is not really an investment, it's more like a savings vehicle, but I thought I'd mention it because at the moment, high yield savings accounts are paying really good yields. We're talking like 4.5%, sometimes even 5%. So a high yield savings account is a bank account, but it's provided by an online only bank. These are special types of banks, very different from your typical Bank of America or Wells Fargo, because they don't have any brick and mortar locations. And because of all the money they save by not having physical locations, they're able to pass on more of the savings to you as the customer. What I like about high yield savings accounts are that first, they're FDIC insured. So if the bank for whatever reason goes under, your money is still protected. They're also very liquid. You can take money in and out at any time. And of course, your balance will never fluctuate. Because if you put money in a high yield savings account, you're just going to get interest every single month. But if you put money in, say, dividend stocks, REITs, or funds, the value of your initial investment is going to fluctuate because the market goes up and down. So high yield savings have no market risk. However, there's a trade-off. You get a consistent interest payment, but the balance is never going to go up. And it's not going to go down either. So there's definitely trade-offs. In the long term, if you're able to hold on long enough, investing in dividend stocks, ETFs, and REITs will grow your money way more over time, but you just have to bucket out your money. If there's money that you can't afford to have fluctuate in value, like it's for a down payment or it's an emergency fund, then you want to keep that in a high yield savings account so you can generate passive income in the meantime, but also not have that money be at risk. But if there's money that you want to put away for the future, like 5+ years down the line, and you want it to grow to the maximum, then you want to consider some of these other investments that we talked about. So if you really liked what you learned in this video and you're interested in really mastering how investing works so you can have total control over your money, I actually created a free resource called the Financial Freedom Starter Kit. You're going to learn step by step exactly how you can achieve financial freedom through investing. And that's even if you're scared, even if you don't understand all the jargon, and even if you don't have a lot of money to start with. The link to sign up is below. So let's just summarize. You've got dividend stocks, you've got dividend funds, bonds or bond funds, REITs, and high yield savings accounts. These are all really easy to get started. You can get started with $1,000 or even less. Now, just because investing $1,000 is only going to generate a little bit of passive income for you and not allow you to quit your job, that doesn't mean it's not worth doing. I really want to emphasize the power of starting small. If investing just $1,000 is going to make you even just $50 of passive income, but you're starting with zero of passive income, that's still a huge improvement. Just think, $50 of passive income can buy you a dinner out for free that you didn't have to work for. So never underestimate the power of starting small. You can start small and just keep adding to it, and that's how you get to financial freedom. It's always a process. And everyone has to start from zero. Everyone has to start somewhere. My first dividend payment ever was $2 from some McDonald's stock that I bought. I didn't know what I was doing. And now I get thousands and thousands of dollars of passive income every single month that I don't have to work for. But I also had to start at zero too. So don't underestimate the power of starting small. Just because you start small doesn't mean you're thinking small. All right, thank you so much for watching. I hope you learned a lot. And in the meantime, I'll see you next week for another video. Thanks for watching. Bye.